Welcome to Deal Team 6, a podcast highlighting the stories and lessons from the M&A battleground, featuring the team of TKO Miller. Each month, we deliver a mixture of stories from previous deals, updates on middle market activity, and guests who have seen it all. Now here's your host, Tammy Miller.
Hello, everyone, and welcome to this episode of the Deal Team 6 podcast. I'm Tammy Miller, and this is my coworker, Tim Waleschek.
Welcome.
And today, we are going to be talking about management presentations. Do you want to tell us a little bit about why someone would be in a management presentation?
So, management presentations are when you are starting to bring back prospective buyers, and they are getting to the next layer of a sales process. You're bringing prospective buyers back. They're getting to spend some time with the company, getting to hear more specifics about the company, and it's often accompanied with a tour of the facility.
Right. But one of the most important part of management presentations is the sellers also get to know the potential buyers. And we encourage our sellers to ask questions. It's kind of like a date. I want to know about you, and they want to know about you, and you want to know about them, and it's this back and forth. But unfortunately, our sellers, when it comes time to ask questions of buyers, who can sometimes be these multi-million-dollar or large funds, and sometimes they show up in suits, and they kind of freeze. They don't know what to ask, and so this podcast is going to be about what questions you might potentially ask a potential suitor, specifically a private equity suitor. And private equity can sometimes be intimidating. Like I said, they come in, they kind of know what they're doing. They buy businesses all the time, and you probably have sold one or maybe two or maybe zero businesses in your life, and so this can be a little bit of a challenge at times. And we're going to do a little bit of a different format. This is new, right? So I have written questions and I've written answers that I'm going to publish as a blog. But I'm going to ask you the questions and see if your answers match mine. So it'll be
Great.
different. Okay, ready?
Great.
Okay.
Hope I don't freeze up like our clients do.
Don't freeze up.
All right, here we go.
That would make for a very boring podcast if you were just silent on the other end.
There we go.
Okay, all right, ready?
Sure.
So the first question is, how often do you visit your portfolio companies? Or another question I thought would be related is, do we have to ever visit you? And why is that important?
Well, I think a lot of these questions are going to fit into a business owner, how's my life going to change? Mm-hmm. Business owners, frankly, are used to doing whatever they want. And this shows up in the way they keep their records, their reporting requirements, who they answer to, and all of a sudden they might have a boss, or they're going to at least have a partner, and that's oftentimes very different for them. So many of the questions focus around what's going to how's my life going to change, because it can be a significant change for them. And so I think your question kind of falls in that category of
Yes.
What's going to change for me? How often are you going to be here, and how often am I going to, have to deal with you? And I think one that I would also ask is, what are my reporting requirements going to look like? Many times we deal with clients who will do quarterly financial statements, which is obviously going to be a change. Most PE groups are going to want to have, at a minimum, monthly reporting packages, and some, we could tell you stories. Some can be rather daunting, and at a minimum, they're probably going to want to have weekly calls with you just to check in on the business. So that's when you start asking a question like, how often are you going to visit? It's kind of, to me, the precursor for how often am I going to deal with you, but also leads into the what's the relationship going to look like, and what's the reporting going to look like.
So what are some extremes that you've seen in the terms of visits?
In terms of visit, well, again, with today, I don't know that visits are necessarily a big deal. I think at minimum you're going to have a quarterly visit. You're going to
or
have
touch points.
Yeah, I mean, extreme wise, you might have a daily call. That'd be extreme. I think generally what we see is a weekly call, but one of the questions might be, how many companies do you have, and how many are you watching?
Okay, don't make up extra questions. There's questions coming.
Oh, there are questions coming.
Yeah. So
I'm an answerer.
Yeah, you're an
Okay.
answerer.
All right.
Yeah.
Well, I mean, the extremes would be if they don't have a lot of questions or a lot of companies they're looking at. Maybe you could have calls a couple times a week. Again, I think visits are going to be probably 3 or 4 times a year. I don't think
On average, I think, quarterly. They probably just. I mean, they're not going to just leave you alone. Generally, they don't just pay millions of dollars and then just say, "We'll see you in 5 years or 3 years." Like there's definitely going to be some communication, some accountability.
I think one thing you need to be prepared for is a lot of private equity buyers and financial buyers, just in general, pride themselves on the first 100 days.
That's true.
It's a big. Maybe, I think presidents do this too. What's the first 100 days going to look like?
Private equity groups and presidents. Yes.
What are we going to do the first 100 days? Many buyers will think about, I'm not going to change a lot. I'm going to come in and observe, which is fine as well. And many will come in and from day 3, start thinking about. Their learning might be very hands-on and being dealing with you very quickly. So that might be one of the questions as well, is if you're worried about how interactive or how much they're going to be dealing with you, is what's the first 100 days going to look like as well, because that's a big one for private equity groups, and many of them are very proud of the first 100 days. And then the list gets long, and they have a big scroll of things they're going to do. So,
and under what circumstances might you visit them?
I think this is a great idea. The best practices that private equity groups bring together. So, most business owners that we deal with are, great business owners, great business people, but they're also great learners, and they enjoy sharing ideas with other like-minded and dynamic business people. And so most private equity groups will have an annual bring the CEOs, bring the CFOs together, bring other senior management together. And it's a great way to learn some best practices. How do you do this? How do you deal with these situations? And that almost happens with every private equity buyer that we've dealt with, bringing them together. So that's usually where you're visiting them, and it's probably a little fun mixed in for a day or two, and then usually you're giving a presentation to the investors of the fund, and then also spending some time with other senior executives from some of the other investments to learn how they're interacting and how they're doing things.
Yeah, and that's a positive visit. That's something where you can get a lot of good things from.
Yeah, and one of the other things that private equity, and if I'm stealing a question, forgive me, but they'll say, we're not just bringing money to the table, but we're bringing relationships. And many times some of these relationships...
You're totally stealing the question, by the way.
I think it's better this way. So, you're not just bringing dollars, but many of these investments that these private equity groups will make, might be in parallel businesses, or businesses where you can not just borrow ideas, but you can also maybe get as a customer, maybe you can get as a supplier and leverage some of the capabilities of other portfolio companies from the private equity buyer.
That's true. Okay, so the next group of questions or area where someone might explore. This is a big concept, and it's difficult for somebody to maybe get a complete understanding of and why this is an important series of questions. But this notion of asking about where you are, how big is your fund, and where are you in its life cycle, and why is that important, and understanding that.
Yeah, no, I think you've come up with some good questions. You should publish these. And it'd be great for our clients. How big you are and where you are in your fund is important because depending on most private equity groups are investing in our clients to grow the business. It's funny, one of the questions is, are you going to come in and fire all the people? That seldom, if ever, happens, and that's the story of maybe the 80s or the 70s of the years gone by. But
certainly a lot of TV movies.
TV movies, yes.
Yeah.
In fact, Wall Street, where Gordon Gekko.
Yeah, right. It doesn't really ever happen in practice.
That doesn't happen. They're usually buying to grow, and many times that's through acquisition. So you're worried about as a seller to a private equity group, how much money do you have to put into the business, to fund growth, to fund expansion. And so having dry powder where you are in the fund in terms of money, in terms of size, that's important. Where you are in terms of the sort of duration of the fund. And I think what people don't understand is that most of these funds, as private equity groups raise them, have a set duration, at least a targeted set duration, where, and it's typically around 10 years, where you start investing in a fund, and when you get towards the end, you're starting to liquidate some of the investments. So if you're early in a fund, let's say in year 1 or 2, you may have a very long runway before that private equity fund starts to sell companies out of that fund. If you're later in that fund, say year 5 or 6, you may be coming up to the back end of that fund, and the hold might be a lot shorter. If you're looking for a short relationship and a quick flip, that might be good for you, but it also might put increased pressure on you to grow much quicker, and you might have a much quicker trigger with the private equity group to be pushing you to do things in a much more accelerated fashion than otherwise might be the case. So understanding where you are in that duration is important, and understanding how much capital they have to put towards your business is important too.
Yeah, and I think understanding a history of what fund they're on. Is this their first fund? Have they just raised a fund, or are they on their third fund and they have progressively gotten bigger? And that is not necessarily super important, but it is a signal of sorts as to what kind of group you're dealing with.
Yeah, I think something that's hidden in what you just said, though, is, and you have to be careful of, is a fund that is on its third $200 million. I'm just picking numbers. Its third $200 million fund. To me, that says they're sticking with deals that they know. They're comfortable making investments of a certain size range. Time and again, we'll see funds that will, their first fund was 200, their next fund is 400, their next fund is 700. Those are different investments, and
yes,
just because you're really good at making investments out of a $200 million fund doesn't mean you're going to be really good at making investments out of a $700 million fund. So bigger isn't always better, and being successful down at a $200 million fund doesn't always translate.
Yeah, those are totally different kinds of companies that you're investing in.
100%.
Yeah.
And so we've got a lot of great relationships where they're in their 6th, 7th fund, and they're always around, again, 350 to 400 million. They know what they're good at, and frankly, I commend those funds a lot more than the ones that continue to grow, and maybe grow out of their where they're good at, so out of their comfort zone.
Okay, all right. I'm going to try to salvage the next question because you kind of took pieces of it. But one thing that people might ask, are there other resources that a private equity group might deploy to help other than cash? So what are some things that a private equity group might offer to a portfolio company other than cash?
Sure. And to try and salvage this, I may steal another question, but when in a well-run process, like if you hire someone like TKO Miller, you're going to get, our objective is to deliver alternatives for you. At the end of the process, hopefully you have 4 or 5 buyers, and the valuations are going to typically be very close. We're looking for that outlier, but typically we can push, the other buyers to get to that outlier. So at the end of the day, you're going to be sitting there with 4 or 5 buyers that are fairly close in valuation, and frankly, if they're not, we're typically able to push them up to the top number anyhow. And so you're forced to make a decision, on other items, not just valuation. Valuation is often the easiest because it's a number, and you can evaluate that and see which one's biggest. But there may be other intangibles, and that's where it comes down to. Maybe it's personality fit. Maybe it's some of the questions we're asking today that you like. But one of the other things that I touched on before is, what else do you bring to the table? What's more than just dollars? Have you made other investments in this area? We're working on a transaction now that where they made an investment in this area and took a business and grew it rapidly. That's very exciting to our client. So that having a track record in that industry is very important, might be very important to you. What kind of resources do you bring, maybe from people you've partnered with within your fund? Some funds have operating partners, they call them.
Right.
And they can bring expertise in to sit on your board or to be advisors to you if that's attractive to you. What do your other investments look like? If you're sort of out there alone and all the other investments are in very different industries, maybe that's less attractive to you. So I think all of those, what else can you bring, to the table, will help you in these decisions. And many times, again, when you're, I won't say splitting hairs, but when the valuations, when we can push those to be very close, many times those can carry the day in who you decide to consult.
And I'm thinking of groups that there are groups that have back offices that help all their portfolio companies with technology, implementing technology or marketing, or bring banking relationships or insurance relationships or help with hiring and HR. So, they try to bring some overarching relationships to all of their portfolio companies to save money and to bring best practices. And some of those will come out at some of those CEO roundtables that we talked about earlier. And some of those are just available resources if you want them. If you don't have to take them, but if you want them. So there's some positives that some groups bring to the table that other people don't have that certainly are worth asking about.
100%.
Yeah.
Yep.
The next group of questions are all around acquisitions because different PE groups feel differently about acquisitions. Although I think all PE groups have growth as a strategy. Not all of them, focus as much on acquisitions as a strategy. So, growth certainly, but acquisitions as part of that growth can, vary from must do to if you find something that you like. So asking about acquisitions as part of a growth strategy is certainly something that you should do.
Certainly. Yeah, no, and frankly, I think one of the things that we always try to explore when we talk about growth opportunities, and growth is an important factor in thinking about valuation. If you look at models, if you look at how companies are valued, how are you going to grow is an important factor in that. So when we think about value and we think about, presenting a valuation to, prospective buyers, growth is a critical role. And how are you going to generate this growth? An obvious one is acquisitions. It's important if you're going to put acquisitions out there to evaluate whether your client can do acquisitions.
Right.
It's not that easy. It's not, it's not always 1 + 1 even equals 2. Sometimes it equals 3, and sometimes it equals 1.5 or a half.
Right.
Unfortunately.
Yeah.
So,
Hopefully not -1, it can go,
sometimes
it can go badly.
Yeah. So I think understanding, what's your thought about acquisitions? Are you going to be able to help me? I haven't done one. I don't think you want to show that weakness, but maybe they should at sometimes.
Right. Right.
Yeah.
If it's a group that's gung-ho on acquisitions and it's not something you're keen on doing, it might be part of your evaluation about whether or not that's the group for you. If you're excited about doing acquisitions and there's a lot of targets you're excited about approaching, that might be a group that you're interested in working with. It's just one of the many things you should be thinking about as you pick someone to move forward with.
I think that begs the question, though. You need to look, as a CEO and as someone that's selling their business, you need to look inward, though, at your skill set. And, can I do acquisitions? Can I integrate? Buying a bunch of businesses, and I've worked in industries where you have, they've done 7 acquisitions in 18 months. And you look at the business and you can tell exactly where the 7 acquisitions are because they still have the same name, they still have the same people, they still have the same everything. You're like, those are just 7 different companies that are now owned by the same people. To me, that's not really acquisitions, that's just buying things. And so, if you're going to do acquisitions and put them together and create a single company, that's different to me than buying things. And so, do you have the skill set to do that? And that's an important skill set that a lot of CEOs don't really
That's
have.
funny. On Friday, I had a CEO call me. They're owned by a private equity group, and he said, I need some advice on buy side. He wants to do an acquisition. He said, as part of our bonus structure, the line item on getting paid for bonus is do a transaction. Those are the exact words. And I said, well, it's not like getting a Girl Scout badge. There should be something behind it other than just do a transaction. We should think about this a little bit more other than just, just do it. Just do it.
Well, back in the 90s, there was a public company in town that the CEO was compensated on doing in multiple transactions, but
I was like, that's failure. That's got failure written all over it.
Yeah,
so we walked through that a little bit.
Yeah, you need to sort of incentivize the right things, and that one does.
Yeah.
That one looks ripe for a disaster.
Yeah. All right. So this one I think can be a little sensitive because some people are shy to ask it. But can I call former CEOs of your other, or current or former CEOs of your other portfolio companies? How do you feel about that one?
I mean, it's a great question. It's one that I think when we get that question, we embrace it, and we actually offer up, call whoever you want on our transaction list. I think it's somewhat self-serving from a private equity group when they get that question, because you're obviously not going to give references or allow calls where it's going poorly.
Yeah, right.
I think even if you get calls with ones where it's going well, though, you're going to get some feel for the interaction, and I think
Definitely.
those can still be valuable. If you ask the question, though, if you're going to go and ask that question, maybe you say, can you give me one where the company's doing really well, maybe where it's not doing really well, and one where it's doing poorly.
Mm-hmm.
Maybe the best question would be, can you give me the name of a CEO that you fired? And because that's again,
Wow.
don't that might be the question you want to ask, because private equity buyers, when things are going well, they're a little bit like banks. When you are doing well and you want to borrow money and you're doing well and don't need it, every bank in town is going to be lining up to give you money. When you're struggling a little bit, you need money to borrow from a bank, and you knock on their door, hey, not today, not today. So, I mean, the biggest challenge in having a private equity partner is when it's when you're struggling a little bit. And so, if you really want to know what kind of partner they're going to be, talk to some where it's a little bit challenging. Not the ones where we grew 3 times in 3 years, and
Right.
that's a really tough question.
Yeah. How about asking about how they typically finance their transactions? And I'm thinking specifically around their philosophy around leverage.
Yeah, I think that's a really important question, especially for, as I talked before, and this is sort of dealing with business owners who haven't had, a boss before or a partner.
Right.
And maybe haven't had a bank before.
Yeah, I
And
mean, because there's
so-
plenty of people out there that are like, I've never borrowed anything,
Right.
and now all of a sudden are going to have debt.
And they're gonna have covenants, and they're gonna have a reporting
Yes,
package,
yes.
and people are gonna be asking them questions, and at times uncomfortable questions. So understanding what that's going to be like and meeting monthly or quarterly numbers, could be uncomfortable. And so understanding how much cushion do I have, and understanding maybe some seasonality in the business or variance in the business, and making sure your partner or your new majority owner here understands some of those things, because they're going to be looking to you as the person running the business to make good on the promises they've made to their lenders.
Right, exactly. And then this might not be totally worked out as of the moment that you're sitting in the management presentation, but you could certainly ask about the tools that they have to compensate managers. And I'm thinking about some private equity groups have option pools, some do not, some have bonus programs that they're happy to tell you about, some have different, they all not all of them, but many of them have different programs that they like to roll out. And none of them will put it down exactly how they plan to put it into this deal right now, and this probably in the management presentation, but they will talk about it in general with you, I've found.
Yeah, that was one of the things that, in 30 plus years of doing this, I guess I was a little surprised that I thought it would be somewhat more cookie cutter.
No.
And, it seems like for every private equity group, and I think we're at 6,000 plus now, there are probably 6,000 plus management compensation, scenarios.
Yeah.
And, pardon the hyperbole there, but they're all very proud of the way they compensate managers as well.
Mm-hmm.
And so their way is always the best way as well. But they're always a little bit coy, they're always a little bit guarded with that. So it may not be at a management presentation, but I was shocked at they're all a little different. They all have their own wrinkle. They all explain why theirs is better. But, when we get late in a transaction and they're still, even at the LOI stage, if you're getting 7, 8, 9 LOIs, and you start driving into the management compensation pool and how it really works, you're probably going to have 7, 8, or 9 different management compensation packages to sort through. And the devil's really in the details on those,
Right,
and you're going to see a lot of
And
different plans.
It's good to understand the differences.
100%.
And then lastly, this is my last question, because I think it's a sensitive one. And I don't know that it needs to be sensitive, but I think it rubs people the wrong way. Do you charge a management fee?
Yeah, it's depending on how you ask it. It's it's an interesting one.
It rubs business owners the wrong way, doesn't it? When they first hear about it, they're like, and then we kind of have to explain what it's for and why it doesn't really matter. But I mean,
yeah, it does. It feels icky.
It does. It feels icky.
Yeah, especially if maybe if you're rolling some equity.
Exactly.
You
or
know,
if you have incentive based, like an earn out or something, and you have to remember to back that out. So there's some things. Well, first explain what it is.
So I mean, what Tammy's getting at is typical. And again, there's many variations of this, but it's not uncommon for a private equity group, and hearkening back to one of your earlier comments, they do provide a lot of back office services and a lot of back office help.
They do.
And so don't want this answer to be a total punching bag, but it's not uncommon for them to charge a quarterly or annual fee for these services. Some executives might feel that the fee is grossly out of whack for the services they're getting and may feel like the services are more of a pain than a service. And so they look at this, $50,000 charge a quarter or $100,000 charge a quarter or whatever it may be, and say, what am I getting for this? And so, especially if you own 10% of the company or 15% of the company or more, boy, it feels like, I'm paying all this money and not getting a lot. As much as private equity charges, they're very good and very quick to explain why it doesn't matter, just like I think you were getting ready to there. And in the end, it really doesn't. But it doesn't help. And, private equity goes out of their way, and, we go out of our way to really explain it doesn't matter. And it really doesn't. But it doesn't help that it still doesn't feel good for the manager, for the seller.
And I want you to explain that nuance. Why, if you roll equity, because if you roll equity, you're an owner, they're an owner, they're getting a fee, but you're getting nothing.
Yeah.
Right? I mean, that's why it might, especially if you're rolling equity, it feels even a little ickier than it might.
Well, when it doesn't matter, because when it comes time to sell, you're going to put all those numbers back.
You put it all back. You add it back, and so it doesn't matter from a valuation standpoint.
It doesn't matter from a valuation standpoint, but those dollars are still going out at the end of the day.
Where do they fall from a bank covenant standpoint?
Typically they're not hurting you. I mean, certainly there could be a covenant that affects that, but again, private equity.
If you were ever in danger of blowing a covenant, they come out below the bank.
Yeah.
And so they're really of little consequence, other than it just kind of doesn't feel good.
Right. So let me sort of throw in a little commercial here, and I won't name names, but there are private equity groups that look at issues that we're talking about: the management fees, the reporting requirements. We haven't talked about actual things that groups do with respect to holdbacks and escrows and things, and how they get deals closed. But there are private equity groups that look at all these issues that make business owners feel icky.
Mm-hmm.
And they say, are these really important? Is this $50,000 I'm taking at a year, is it really important? Is having a 10% escrow, how often do we have claims? And, do I need 18 months on my survival of reps and warranties? There are groups out there that look at these and they say, no, they're not important. And they carve them back below market. And when we show these groups and they're in our processes, business owners, with our help, aren't dumb, and we're not dumb. We see 8 bids over here that have cookie cutter responses to all these questions, and then we see one of these smarter private equity groups, and they go, why is that one like that, and why is everybody else like this? And we say, well, they're a little bit sharper. They
or different.
They are different.
Yeah,
And they looked at all of these issues that make you feel awkward or icky, to use a scientific term, and they've taken them out because at the end of the day they don't matter, and they don't matter to them, and they get deals because of that.
Right, they do.
And
they do.
And it's silly. And there's some big names out there that do a couple hundred deals a year.
Yeah.
And there's some firms out there that do 50 a year. And they go, why do you favor those guys? No, they do the work themselves. And so, for any private equity groups that might be listening to this, look at the things where you get pushback and say, is this really important? Do I really need this? And stop just saying, we've always done it that way. Because that's a silly answer and it's costing you deals. And no one's going to come out and say it cost you a deal, but we see it all the time that it's costing you a deal. Because not everybody's doing it. And just because you always do it that way, it's not a great answer. So, that's my public service announcement for the private equity
Okay, all right, that's
industry
good.
today.
Very good.
There you go.
All right, well, that's all I had for questions. So this is
Excellent.
also going to be published as a blog.
Excellent.
Yeah, so people can actually have the physical list to bring with them to a meeting. If
All right.
they'd like, they can either listen to this as a podcast or they can bring the list with them to a meeting, and they can just be better. They can be better informed if they're ever sitting in a management presentation, because I think this will give them a much better understanding of who they're dealing with. If they were to ask these questions of that group of people that they were talking to, they would, along with comparing prices, you'd be much better off.
That article will have to be very dynamic to keep up with this podcast, but
It's a pretty good article.
okay.
Okay,
I
all right.
wouldn't be surprised.
Okay,
So.
all right.
It was fun. It was fun
good.
today.
Thank you.
Thanks.
for joining me.
Yep.
Thank you for joining us today. Make sure to visit our website at www.tkomiller.com, where you can subscribe to the show. While you're at it, please check out our seller resources page, where you will find frequently asked questions on mergers and acquisitions, family and founder-owned businesses, and a host of other interesting topics.